Bitcoin was the first day it closed above 100,000. To me, it was a key threshold. But since then, gold's up about 30%. Bitcoin's up 7%. Stock market's barely unchanged. That's the total return. To me, that's a sign of a threshold similar to 5,000 in the NASDAQ in 2000. Some of us remember that really well. So to me, this is a sign that the massive speculation to this digital asset that helped get the president elected because he tilted over and finally turned in favor. Just point out things where he wrote about 5 years ago.
We're going over the latest economic data and the outlook for the markets, economy, gold, Bitcoin, commodities with our next guest, Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Welcome back to the show, Mike. Good to see you.
Good to see you, David. Thanks for having me back.
The revised GDP numbers. Let's start with that, and then we'll talk about PCE as well before we get into some commodities. Revised GDP numbers released to almost no media attention at the end of last week. So we're seeing GDP falling, revised GDP falling by 0.5% rather in Q1. The stock market is hitting still new all-time highs. So walk us through some of this. Also, we'll be talking about personal income as well. Personal income fell in the last quarter versus the last quarter. So it looks like things are slowing down for economic growth, yet at the same time, we have stock markets hitting new all-time highs, we're hitting previous all-time highs, like I alluded to earlier in the introduction. So walk us through this. Help us make sense of this seemingly, difference or dichotomy here.
I think the stock market is anticipating the bill from this great big bill to make a big difference with earnings and markets, and anticipating Federal Reserve easing. But it could be potentially a bit irrational and delusional at this point, because by the stock market going up, making record highs, and things like Bitcoin going up, making record highs, it's increasing that inflation pressure on the Fed. And it's just silly to think that the Fed would be easing in this environment, because typically that's where they hike rates. It's just not usually how it works. But markets front running. I think it's in a stage now that it's never going to go down until it starts going down, because there's so much buy to dip momentum going on. But everything, as you pointed out, I mentioned earlier, is actually starting to tilt lower. For instance, we expect our Estelle, who is our economist, who's filling Anna Wong this morning. Our morning meeting expects it. The employment rate to pick up to 4.3% on Thursday. Expects non-farm payrolls to be a bit weak. She sees gains in leisure and hospitality slowing down. Gina Martin Adams, our equity strategist, sees that the the market actually is depending on Fed easing. This complete concentrated returns, the S&P 500, the top 52 stocks are accounting for over 99% or so total returns. And there's alternatives outside the U.S. For instance, growth in techs outside of the U.S. is much better. So I look at it as this is part of a bit of end of the summertime, end of the first half rally, and the risks are that we go back lower. I look at more of we're entering some of a lose-lose now. Stock market going up means inflation stays sticky. The wealth effect is extreme in terms of GDP. It's the highest in 100 years. And there's no reason for the Fed to ease an environment, yet tariffs are going to start hitting earnings and that's already a factor. So right now it's great, it's wonderful, but part of where you see that is in gold. Gold's up 25% in the year. It's doing quite well, and I think that's a key indication that the rock beating stocks is potentially going to accelerate into year end.
Okay, we're going to talk about gold in just a minute, but let's talk about inflation, which is one of the drivers, or at least inflation expectations, one of the drivers of gold. So PCE price index inflation came in last week, monthly up 0.1%. Core, excluding food and energy, up 0.2% monthly, year over year, 2.3%. Core 2.7% year over year. Are these in line with your expectations, Mike?
For our economists, the Fed, these numbers are expected to increase into year end. Now we've had some good numbers lately, but that's not a good sign for cutting rates. And to me, the key thing, the number one pressure factor to make these levels, which are still up, remember we kicked in that money supply from 2020, still inching higher, just not at the higher rate, is the number one factor for them to revert lower is the U.S. stock market going down a little bit. So it has to stay elevated. And that to me is kind of the key thing that's happening in the markets overall. This is wonderful. It's a great environment, but I'm worried about the key thing. Like I wrote for my outlook for gold for this year's the range between 3,000 and 3,500. I brought it back to gold because to me it's a good leading economic indicator. Meaning if we're above 3,500 by the end of the year, which is kind of my base case, that's not a good sign for what you pointed out for stock market and everything. And it's more deflationary because I think that's the greater risk. Things you see in China with that yield at 1.65%. If we can get gold back down towards 3,000, that would probably be a good sign the stock market's doing fine, rates are higher, and everything's doing fine in this country. And to me, that's part of where we are, and it's still elevated. Gold's still elevated. And key thing that's happening so far since the last time we spoke is we've had that big spike in crude oil. It's starting to roll over.
Wait, did you say that if gold goes to 3,500, that's a signal for deflation?
Yeah.
Am I
So
getting
that's
that right?
why. Yeah,
Okay.
I'm glad you asked me about that because this is the situation that's in China right now, 1.65% in the 10-year note yield. Most of the rest of the world facing severe pressure on their economies by curtailing exports to the U.S.
Uh-huh.
Top three economies in the world outside the U.S., China, Japan, and Germany, their average yield in their 10-year notes are below 2%. It's not a good sign for inflation, sign of deflationary forces. But to me, that's what's happening. And the key way to watch that is watching the number one commodity in the planet, crude oil. Crude oil's down about 10% in the year. It just had a spike to near 80 because of potential for war and supply disruption risks. And now it's starting to tilt lower, back to $65 a barrel. I think it goes to 40. It's not profound to say that since it peaked at $147 a barrel in 2008, every low has been around 40 or lower. What changes that? We have declining demand out of China, increasing supply in the U.S. and Canada, which is a pressure factor. So there's a number one commodity, somewhat deflationary force. For gold to go up on inflation is, to me, this is more what typically happens. Gold will go up on inflation or go up on deflation. In an environment in between, it doesn't really do much. And to me, this is more deflationary environment, which is normal after inflation.
Why is oil going to $40, Mike?
Because first, it's an excess of supply versus demand. The average cost of break-even cost in this country is around $57 a barrel. Actually, it's below that. That's the average price in 2019. You basically have to get below that cost, and it's normal for commodities to go to their cost of break-even cost or cost of production. Basically, have to get below that cost to offset this excess of supply and surplus of supply in the world. OPEC, US, Canada, and decrease in demand, most notably China. It's a normal cycle. And the key thing is it's done it 3 times since 2008. So I've been saying that since 2022. People on your program have heard me say that before. Admit it, been early, maybe not wrong yet, but it's been a normal cycle. And now we just have excess of supply. And the key thing to remember is rapidly advancing technology. But 50% of auto sales in China now are EVs.
So going back to gold for just a minute, what you're saying is gold going higher this time around is signaling actually a slowdown in economic growth and
Yeah.
perhaps a correction in the stock market. It's not signaling higher inflation.
No, not in my view. I don't think so. It's basically gold at the end of last year was relatively expensive versus everything, most notably other commodities, um, um, silver and things, but it's very cheap versus one key thing, the S&P 500, U.S. stock market. So it's starting to recover. S&P 500 is about 5%, up about 5% this year. Gold's up 25%. To me, that's part of that reversion of the per ounces of gold going back to about a 1-to-1 historical ratio with the S&P 500. Right now, S&P 500 is just above 6,000 and gold's running 3,300. So it's a matter of time. I think it gets back there, and just do we have that catalyst to do that? Looks like it's kicking in. But to me, this is more a normal cycle of deflation that follows inflation. And by deflation, it means something that goes up too high goes down. And the number one major final asset in the planet that's way overinflated by some measures is the U.S. stock market. So a good simple thing I just will be publishing them by the time we put this out on July 1st, this is June 30th, is you look at the earnings yield, the one-year earnings yield on the S&P 500, it is about almost 50 basis points negative to 10-year note yield. That's the lowest in since 2002. So it's just an example of how how elevated stock market is, how low the earnings are, and what's your alternative? You get risk-free treasuries at right now 4.25, and that 10, that long bond peaked around 5%. It looks like those are tilting towards deflationary forces, and to me, the key thing that's stopping it is a stalwart U.S. stock market, which means the risk is it's got to stay strong, or we tilt over toward a normal deflationary cycle.
Here's a chart showing the Dow versus gold. This is the Dow Jones to gold ratio, 100-year historical perspective. The
There
Dow's
you
currently
go.
at 44,000 points. Gold's at 3,300, so that's about 13.45. Yeah, 13 ratio. So where is this chart heading, Mike? And what is this signal from? Yeah,
That's a good one. I'm glad you showed. You see that rollover? That rollover you see there is very similar to what happened in 1971 when when President Nixon ended the U.S. gold standard, and it looks like it's rolling over now. It's bounced, but right there, a little bit for right there. See how it rolled over? That's
yeah,
what I think we're doing now. But it's not going to be easy. There'll be bounces. So to me, that's what's happening. It's just going to go back towards who knows whatever the mean is. We'll start with 10 on this chart. Um, and
sure.
there you go. There you go. So that's one of the key things I've been looking for. It's just been taking a little while to do it. It can't be easy. Remember, what do we have, like a 100-year chart here? So the day
Yeah,
trade doesn't matter.
it's only happened a couple of times in the last 100 years. So 13 has happened in 1973,
Yeah.
96, and then 2008, and then a couple times throughout the 2000s, and then now. So I think what's different from the 80s to now, sorry, the 80s to 2000 and basically 2001 when gold peaked, that was a period in which the Dow to gold ratio really went up, despite the fact that gold peaked around 2001. What's different this decade from the 80s to 2000s or late
Oh, the
90s?
relative elevation. Right now, U.S. stock market cap to GDP is 2.1 times. It's the highest since 1929 or so. The U.S. stock market cap to the rest of the world's GDP, the rest of the world's stock market caps. It just recently was a few months ago, unless you're the highest in our database going back 56 years. That's what's changed. Right now, the market's much more financialized. But the bottom line is it different this time? And to me, this is what gold's sniffing out is that the U.S. stock market's extremely elevated. And we probably, what's one thing that's different is we might have reached the end game of Federal Reserve easing. And this chart, what you can see, you can't see, but what's really happened is we have the recent example of way too much liquidity, pumping too much money in the system, and the excess inflation that came out of that from COVID. Now, somewhat of that is not just from pumping too much liquidity, but that's basically what happened. So now we have the lesson of, okay, when the stock market starts rolling over, can we just throw money at it like we did last time to keep it elevated? And the risks are we've reached the end game. And to me, that's what gold's telling us. Things like very elevated in say almost 18 million cryptocurrencies, excess of supply, a lot of hubris in that space. They're telling me that
Yeah.
we've probably reached the end game of massive wealth creation in the U.S. And to me, that's part of what gold's picking up.
The report that you have here called Mid-Year Commodity Outlook, Gold's Warning or Faint. So key topics, gold versus everything else. Gold's $3,500 resistance, WTI's $80. So here you said the commodities may have bottomed versus stocks. Is that versus stocks is the key word? Are you saying stocks have peaked, or are you saying commodities have bottomed in absolute terms?
More the former, because that's part of the thing. The way we started last year was you looked at the S&P 500 divided by the Bloomberg Commodity Spot Index that reached the lowest level in about 25 years. So there's a lot of room for reversion. But what's the for commodities to go higher? You have to start with crude oil. When we see they're oversupplied, it's not working. Okay,
Yeah.
well, gold's the only one that's really holding the Bloomberg Commodity Index up. Now, a little bit industrial metals, but they're distorted by tariffs and coppers. So the bottom line is the key theme out of that is it just shows how expensive the stock market is, not just versus gold, not just versus commodities, not just versus GDP, not just versus earnings, and the rest of the world's stock market caps. You can just see that's probably a sign that that's where the sore thumb is, and you just have to look for catalysts for reversion. And so far, we've only had a little tweak this year. We've had that quick V bottom, and this recovery has been one of the fastest in history from such a bottom, which typically can happen. Maybe we're making a double top. I don't know, but it's just not a level I think you'd be overweight risk assets when they're this expensive versus some other more traditional assets. Like I showed you gold earlier, and you just mentioned the one from S&P 500 for the broad commodity index.
Yeah. And here are the three keys for 2025. Whoops, I don't have a terminal with me. That's why it's giving me that. So let's zoom in here. Gold and elevated deflation from inflation risks. Stretched U.S. stocks, waning China tariffs. You talked about that already. Crude supply cut. Drought could spike commodities. Um, I think what does this mean practically speaking? So are we talking about elevated gold levels to $3,500, and then lower stock prices and then lower oil? Is that basically the investment thesis here?
Well, then the thesis is gold is high this year, is 3,500. It's very disconcerting. That put it up about 33% in the year. And in history of the last 100 years, there's only been a handful of years that have been up that much. Some of them, one was key, one when we devalued versus gold in 1933, 34, and the rest were inflation in the 70s. Now, this is not inflation right now. It's the opposite. The key thing I want to point out from there is we're in a bear market for most commodities, mostly crude oil, grains, the elastic ones, but we're in a bull market for gold. Gold's an enduring bull market. It goes up over time. Part of the reason is it doesn't have that elasticity of supply, even though it's an ancient relic and store of value. But what I put in the green there is what are things that could make commodities spike? Well, if you kind of some kind of crude oil supply shock, which we just kind of checked off is not happening at the moment in the Middle East. We could have a drought that'll spike up grains, which so far is checking off. We're not having that. Now it's July and August starting. Those are the key times. But the bottom line is, and everything is, you need the stretched U.S. stock market to keep going up to avoid the normal deflationary cycle that happens. I'll give you two examples in history: 1930s in U.S., the 1990s in Japan, when you get to 2 times GDP. So we have to stay there. And I think our Trump administration knows that. How do you keep those levels? And they're trying to do plenty of legislation to do that. But I think they have the unfortunate unfortunate bad timing, like President Hoover did when he came in when the stock market was already too expensive, and it just found a reason to go down.
Let's talk about deflation. We haven't talked about deflation yet in more detail. You've talked about deflation on my show several times. I think that that may still be your view, given that we talked about gold. $3,500 signaling weaker economy. How do you balance a deflation with tariffs?
Well, first of all, tariffs are a one-off, and the way deflation really works is when you have an asset, let's say the price of a home that goes up to 400,000 from 200,000, which is what we've done in the U.S. average home price maybe the last decade, and it goes back down to 300,000 or so. That's deflation, just from a previous level. It depends on what period you measure it. So for instance, right after crude oil spiked in 2022 and 2023, we saw some deflation in the 12-month measure of PPI because crude oil dropped. The last time we had that happen was in 2009 because that 12-month measure measured lower. So always remember what inflation is. It's a price level over time, and you measure it on 12-month basis typically, and oftentimes that 12-month basis, that price measure could be lower. And that was the key thing for everything is let's look at deflation in, say, crude oil. The price has deflated well from 130, basically dropped 50% from 130 peak in 2022. At the same price right now, 65, was first traded in 2006. Okay, that's a commodity. Get it? It's elastic to supply. So elastic to supply and demand. Look at the Hang Seng Index. It's probably unchanged over a 20-year basis. That's probably deflationary. And the key thing that's been inflated is U.S. stock market. So it's the measure over time and where you measure it from.
Mm-hmm. And given that you think oil is going down, I'm guessing you don't think the Iran Israel situation is going to blow up.
No, it's already past tense. What we learned was it's accelerating the process of the key things that's really pressuring crude oil is the excess of supply and demand out of U.S. and Canada. Now, that's been one of the most enduring trends for almost 20 years, and it's accelerating. U.S. and Canada excess of supply versus demand is over 6 million barrels a day now. 2008 or so is the opposite. It was a surplus. There was a deficit of 11 or 10 million barrels. At the same time, China's imports of crude oil, about 11 million barrels a day, have stalled. First time in almost 30 years, stalled around 11 million barrels a day. And it's starting to tick lower, particularly
Yeah.
as they face. Now, the rest of the world is facing these tariffs. They just can't export like they were able to before. So that's a pressure factor on all their demand pull forces. But the number one thing to remember about inflation, it always comes on the back of inflation first. It's just when high elevated prices go back down. And remember what the foundation for what I've been speaking for about 2 years is, almost more than 2 years, is the biggest money pump in history. All lessons of history, the price of time by Edward Chancellor point out, when you pump up that much risk assets and money supply and things, then you eventually go down. That's my point is what's happening in China is very similar to what happened in Japan. They're completely dependent on fiscal monetary stimulus. They're trying to export this deflation to the rest of the world, getting pushed back. And then there's that one key trigger. What stops that from happening? President Trump is trying to pressure the Fed to ease, but they can't really ease. They're in an environment where they actually almost should be tightening because risk assets are so elevated and keep going up and creating more inflation.
Okay, let's close off on Bitcoin. Bitcoin and gold may lead the way lower this year.
Yeah.
That's your report. The newly unprecedented premium in U.S. equity prices is ripe for some normalization. We talked about that. Excuse me. What does this mean for Bitcoin?
Could you scroll down to show that chart a little bit?
Yeah.
It's one of the, I think it's the best leading indicator, Bitcoin gold ratio, one of the best leading indicators on the planet. And what I show is the Bitcoin gold ratio has started to roll over. Now, this is just an annual chart. And I show an annual chart because you have to remember we only have, 15 years of data. And only the last really less than 10 have been relevant for Bitcoin. 2017 is when they came in the forefront of futures. The key point is that Bitcoin to gold ratio has been rolling over, meaning this new digital form of gold versus the ancient store value is starting to roll downward. At the same time, the stock market's going up. But there's only been 2 times since Bitcoin has been around that we've had the total return of stock market that was down. You can see those in the red lines. That was 2018 and 2022. Right now, Bitcoin gold is a bit of a dichotomy. It's rolling over, it's trading lower, yet total return to stock market's up. So here's what are iterations. We have 6 months left the rest of the year. Will the stock market be up? Maybe that'll pull Bitcoin up. Bitcoin's a risk asset, trades as a very high correlation to the stock market and a low correlation to gold. Can it do that? Well, we'll see. My bias is the risks are the stock market tilts lower and legitimizes this front-running move, the Bitcoin to gold ratio. The key thing I want to point out is Bitcoin is just one of what are about 18 to 19 million cryptocurrencies now. There was only one in 2009. Now there's millions. And a good way to measure that is a Bloomberg Galaxy Crypto Index. On the year, despite the stock market being up 5%, that index, the Bloomberg Galaxy Crypto Index, is down 15%. Bitcoin actually has a much higher correlation to other cryptocurrencies, depending on which one you're due, than the stock market. So to me, the risk is that whole space of massive speculation, trading, and hubris goes down, leads to this deflationary forces, and just like a internet stocks in 1999, 2000, and heads lower. So far, it's doing that, and we're just at that nice pause at the moment.
How is 100,000 Bitcoin fuel gold? And then we'll close off here with your outlook.
Perfect. I don't know if there's a chart below that, but typically so it's right there. Since we've reached 100,000, that was December 6th, the first 3 p.m. close above 100,000. Now, closes matter now for Bitcoin. People say it doesn't close well with ETFs. They close at 4 p.m. On that day, December 6th, Bitcoin was the first day it closed above 100,000. To me, it was a key threshold. But since then, gold's up about 30%. Bitcoin's up 7%. Stock market's barely unchanged. That's the total return. To me, that's a sign of a threshold similar to 5,000 in the NASDAQ in 2000. Some of us remember that really well. So to me, this is a sign that the massive speculation to this digital asset that helped get the president elected because he tilted over and finally turned in favor. Just pointed out things where he wrote about 5 years ago. Now is at a level where I look at it's kind of, it reminds me of the nomenclature. You should be selling when they're yelling. And there's so much yelling in this space. Bitcoin looked great at 10,000, but at 100,000, it's just highly risky and speculative. And this is what it's showing. Gold seems to be picking up on that.
Okay. Well, you don't think they're related though, right? Gold's tear and Bitcoin's rally in the last 18 months, has one driven the other, or is it just a general kind of inflation of assets that will happen?
Oh, I think they're highly related. So the way I like to describe it is, in the world going digital, it might be inappropriate to hold gold anymore and to invest in gold without some Bitcoin in that space. The world's going digital makes a lot of sense. And there's been times when you should be overweight Bitcoin and overweight gold. And when the stock market's going up, I'm almost always supposed to be overweight that speculative digital asset Bitcoin. But now, as we've reached the potential apex and just how expensive the U.S. stock market is, and everybody trying to keep push it higher, where they know it's pushing on a ceiling, Bitcoin could be indicating the ceiling. And so far, my call has been, I think, appropriate that 100,000 Bitcoin is a sign of a ceiling. And so far this year, now one thing that's happened just recently, we've just reached the highest level in gold ETF inflows and holdings since 2023 after 4 years of outflows. So there's been gold ETF inflows. They're really picking up now. They're in Bitcoin too. But to me, this is a sign that people are starting to realize, okay, I need that store value. The rock's beating stocks. It's certainly beating Bitcoin this year. And the key way for that to continue is if the U.S. stock market rolls over a little bit. And I think that's just some prudent risk allocation, reinvesting coming in, and prudent money management where people are saying, yeah, some of these assets are just too expensive. And I always like to tilt over to things like Dogecoin. It's number 8. It's worth $25 billion and it's a joke.
All right. So where's Bitcoin going? Where's gold headed in the next 6 months? Which will outperform the other?
If I think the greater risk is that Bitcoin goes down with the stock market and gold goes up. To me, there's a potential that Bitcoin could drop to zero. I mean, it's done it in the past. I made the same call in 2018. People were upset with me, but it did get 70% of that. Went down to 3,000. The key thing is if you look at the entire crypto space, I think the entire crypto space can easily drop to zero, meaning drop 90% and still be legitimate. But that's the problem. Bitcoin's highly correlated to that space. So let's put it this way. By the end of the year, let's say stock market's up 5%. Let's say it ends up down 5% or down 10%. That's a key signal for gold to go higher and Bitcoin to go lower.
Okay. Thanks very much, Mike. Where can we learn more from you?
On your show. Thanks for having me. On Bloomberg. And on LinkedIn, Mike McGlone. I'm sorry, Mike McGlone at Bloomberg Intelligence, and on X at Mike McGlone 11. And David, thanks for having me.
Thank you for coming on as always, Mike. Our audience loves you, so we appreciate your time. And we'll put the links down below, so make sure to follow Mike there on social media. Pleasure, and we'll speak again soon.
Yeah.